Okay, welcome. Today we're going to dive into our debt offerings. This is really something that picked up in 2024. Debt has been there's been a lot of private debt opportunities out there for a while. It's been something we've talked to our LP community about for many years. And then 2024, kind of the stars aligned for what was happening in the market. And we issued some of our first debt, we'll call them products or debt opportunities into the market. And overall for 2024, we did 8 different deals, a little over $10 million that was put out. Obviously, some of those are bigger and smaller, but we were kind of just getting started identifying what the opportunity was. So today we're going to go through kind of what we saw in that opportunity and why it was there and what's happening in the real estate space, and then go through 3 types of offerings that we did on the debt front.
Right, and there's a lot of debt funds out there that are sizable funds that lend to mostly value add opportunities because that's where there's the biggest gap in the market. So if you think about a multifamily deal that's fully vacant or needs to be fully vacant to renovate and bring back up, Fannie and Freddie don't have a great product for that. So there's a lot of public debt offerings. You find them, in the stock market. You also find them in, just larger institutions that lend towards that. Well, for us, we're more looking for relationship opportunities that we know the sponsor, we know the deals, we know the markets, and we can kind of get in a really low leverage position in more relationship lending.
Yeah, we're not like publicly advertising with a billboard that here's loans that are available for anything.
Right, and especially specifically in the multifamily world, it's so highly competitive between Fannie and Freddie, community banks that want it, and then all the other private lenders
Like
that
private mezz lenders.
yeah, there's just layers of capital that we're not competitive in that space, and it's just not of interest that we're looking at other opportunities.
So the reason that we started working on some of this stuff is really what's happening in the banking world. So when we were going out and executing on deals, 2 things happened really at the end of 2023, kind of going into 2024 that created this. Was one, obviously interest rates got a lot higher. So all of a sudden, if rates are 3 to 4 to now 7, 8, when we've had debt quotes at 9 and 10% from lenders, we're like, well, at 10%, we'll probably just do it ourselves.
Mhm.
Right? We would just keep that, just keep that. So higher interest rates, but then also this concept of we would get retraded on bank debt. So if you're going into a deal and you're kind of working your capital stack for the whole project, I mean, the bank is typically the largest investor. We look at the 100% of the dollars that have to go into a deal. You've got LPs, GP, and bank debt, but they're really all investors in the deal. So you got to get everyone on board with what the deal looks like. And 2024, we were seeing a good amount of retrading or repositioning with banks as they were doing the lending. And that makes it really hard if you're 2 weeks out from a close and they're going to reposition what they want to do on the debt side. So we're like, okay, hey, some of these, and that was normally happening in smaller debt pieces, not big pieces of debt, but smaller ones.
Right. When we and specifically talking about retrading is that we would go into a loan assuming the bank term sheet would say you have 65% leverage at say 6.5%. And then they would wait 6 to 7 weeks while they did their diligence. They got the appraisal back. They talked to their board of directors, and they got formal approval. And we got the commitment from the bank, which normally happens 1 to 2 weeks before closing. It would come back and say, instead of 65% leverage, you get 55% leverage. Instead of 6.5% debt, it's now 7.5% debt. And it just kind of flips the deal on our end totally upside down because as our investors know, it's like we have a very defined plan. We raise our capital, we close the capital raise, and we close the deal. And then the banks threw us in this tailspin a week or 2 before closing. Say, hey, you need to raise an extra 500 grand, $1 million. Sometimes it was closer to $2 million. And it just became very unreliable.
Yeah. It was the opposite of what we were telling our LP
Right.
individuals on it. So those 2 things tied together really created that opportunity of saying, hey, maybe we should look at this. Maybe there's other people that are seeing the same problem out in the market, and who's out there that we can work with.
Exactly.
So we did that, and we did 8 deals that fit into this. Our typical deal structure on the debt side is we're making an investment into that property. We still look at it as it is an investment. You're committed to that project, and we are looking to get our debt payments and then make distributions on the 10th of the month every month. So it's more of a monthly cash distribution. Obviously, on kind of debt, there's not upside or there's not profit sharing. We know what our maximum return is going into the deal, which is the opposite typically of an LP position. You normally have that upside. So on that front, we know, we got a good forecast of what it looks like. We're making distributions on the 10th of the month. So there's really 3 types of projects that we invested in through debt this quarter. So let's talk about the discount, the lots one first. That's one of the deals we did where we really invested with a company that is going out financing lots for individuals, not neighborhoods of tract homes, like one piece of land that you're going to buy and build a home on.
Right. Yeah, they're for individuals, and these lots were, I mean, they have access to lots all over the country. They had a bunch in Alaska. We kind of cherry picked the states that we were comfortable buying the notes in, bought those notes, and then basically get a, monthly payment from the lot owner. And, for the most part, we're buying season lots. So at least 9 months of seasoning on them, meaning that there's on-time payments. And we're looking for low leverage positions. And then we also have a guarantee from the group that we bought them from that if a lot defaults in the first 3 years, they'll replace that lot or they'll just pay us off. And we've had a couple defaults because the nature of the business, and they're making sure in their promise by either paying us off or replacing the lot. We've done a combination of both.
Yeah, and we've also had lot payoffs.
Mm-hmm.
So in that deal, we were looking to loan money and have it go for like a 5-year period, and we're basically getting paid off faster in that deal, which makes our IRR improve. But it's also, we're not earning the interest for a longer period of time.
Right.
Exactly. But that deal has been great for us.
Mm-hmm.
It's worked really well. Working with that company has been good, and we're making consistent distributions there, and that deal just continues to perform. The end of this fourth quarter, since we had more people paying these things off than expected, we're making a pretty big profit sharing distribution this quarter. As we have more cash in the door to distribute there, so you'll see some extra returns that come out from that one.
Yeah, this one specifically, we were looking at kind of a 5 to 7 year time horizon on the money that we put out. It's probably going to be shorter for a lot of the money. Some of the money will go full term, but the majority of the money will probably be a little bit shorter as we get paid off.
Yeah, so instead of 5, we're probably looking around 3 years.
Right.
Is our total average payment history on this one.
Mm-hmm.
So that's one of the tranches of stuff that we issued on. The other one we did was really first position notes.
Right, and the first one of these really came up is we were selling an apartment complex, and he wanted to do a big value add story, and it was very convenient for us to stay in the deal, and so we stayed in at like a 30% leverage, maybe 20.
Yeah, like 20%.
Yeah, of basically of his capital stack, and it was a deal that we knew. We owned it for 7 years. We made it was a handsome return when we sold it to him. And we got to stay in for for a healthy debt position, and while he renovates the deal.
Yeah, so he bought the deal all cash,
Mm-hmm.
and then used the amount of financing we provided to then say, hey, he's gonna do his unit upgrades with that. So very comfortable with it. Making the monthly distribution on that. He's making his monthly payments, so it's a good deal, and we're in first position on that deal.
So on an asset like that, when we're going first lien position, we know the asset really, really well. And so, people ask how you underwriting this, how you looking at the credit leverage. It's like, listen, we're in first lien position at 20-25% leverage. There's not and we know the asset, we know the background of it.
Yeah, we owned it for 7 years.
Yeah,
so there's not that many that we can say, hey, we're only going to do this on deals we've owned for 7 years. But if they're in neighborhoods, we know if they are low leverage, if it is first position, we know the plan of the deal. That's where we get comfortable around it.
Exactly.
And and then the other part of that is we did it on deals that we purchased.
Mm-hmm.
So we purchased deals. We're like, hey, we have a note that's going to be tied to this, and we were looking at the terms of the note, and we're like, we can do this for
the same, if not better, easier. Yeah, without the risk of a retrade right before.
Yeah. So we took that same interest rate, and that's what we put on that first position note. We did it on our own asset that we were buying. So in that deal, we're both sides of the capital. That was a Dollar General that we bought. So we have an equity chunk, and we have a debt chunk. Right. That's getting paid out on it. Exactly. And it works really well there. And the same thing, consistent distributions on the 10th of the month.
Right. And so I think at times we'll be looking at doing that more often, specifically with 1031s. 1031s require that you replace, when you roll the money forward, you have to replace the debts part of the capital stack and the equity. So you can't override the debt with all equity. You can't override the equity with all debt. It has to be the same metrics. So if you're selling a deal that has 70% leverage and the best you can get from a bank is 60%, you have a gap that you're going to have to pay taxes on. So we would look at saying, okay, how do we provide private debt for this, solve the debt solution, and then put the equity on top.
Yeah. So let's think about that. It's if you did a loan 4 years ago, interest rates were a lot lower, and you were able to do a cash out refi, which was the predominant multifamily investment strategy for better part of a dozen years, is execute that. Well, now if you go to sell that deal, you will not be able to get a loan on whatever you roll your money into that matches the same debt to equity ratio of that project. And therefore, if you went from a full cash out refi and you had 80% debt to equity value in the deal, because you got all your equity out, really, it's even more, but call it 80-20. The loan you're going to get right now is going to be like 50%,
Right.
60%. So you're going to have a big spread that is then becomes taxable gain.
And again, debt is treated just like equity on a 1031. So even though it's more paper and it's not tangibly your dollars, you still have to replace it or you get a tax bill. So if you don't place, say, $100,000 of debt, you get a tax bill for that $100,000.
Yeah. So when we're looking at deals, we're saying, okay, we have to find a way to create the same debt to equity ratio on a deal we 1031 with going forwards. Or someone else will have to do the same thing when they're looking at their 1031. And therefore, we can come into that deal and be the debt side of it on the asset.
Yep.
It helps maintain the 1031 tax treatment. It also gives us an opportunity that it's there. That opportunity is probably not going to be there forever. It's one of those things that it exists right now, but how long will that be there? It probably won't be there forever.
Right.
So if we can take it, use that as an opportunity, it's great.
Yep. Yeah, and in the last really first lien position we did was on one of our mobile home parks. The bank was not really giving us even remotely interesting terms.
Yeah.
So we basically just matched the terms on other private debt deals we did and paid off the bank. It was around a 30% leverage position. It's a win-win for really everyone involved, for the mobile home park, for the debt investors, and overall.
Yeah. So that one works pretty smoothly, and that's where we can come in and just do things a little bit quicker. We don't really have a fee structure on it. We're not doing points in. We're not doing points out. We're not doing yield maintenance on how a loan is paid off. We're not doing any of that kind of stuff. It's just the direct, really just direct financing.
Yeah, and it also, the flexibility of the prepay is a big thing in commercial lending. Also, the flexibility of the term is, the way we're structured, especially because it's arm's length with our investors. We can do a 3-year term. And then at the end of 3 years, if we want to keep it going, we just have a conversation with the investors, say, hey, do you want to keep this going? Or do we want to pay it off and bring another batch of investors? So it allows a lot of flexibility.
And we do that with all of our when we hit term, it's like, let's talk to our investors and see what we want to do here. We want to recapitalize something, sell it. We want to keep it going, keep doing it, and just see how it's performing.
Yep, exactly.
All right, so the third part that we did on the debt front was really looking at what can we do on the land front. That's where we the other parts.
And the approach was more like an opportunistic partnership. Was is there an opportunity to partner with a land developer and get involved in a really really good piece of land, a really good market, and that has a good runway on it. That we it's not our expertise to develop land, but we can partner with a group that we can be along kind of for the whole ride. So we partner with his name is Dharma. His company's called Epitome. And he had the raw land. And the 3 deals we did with him were different stages, but basically he had the raw land. One stage is take the raw land to fully entitled. The next stage is fully entitled to horizontal development. And the last stage is to vertically develop and build. And so every one of those steps you can exit. Right, you can exit after entitlement, you can exit after horizontal development, or you can vertically build it and exit then. So we like the optionality of being involved there, and also the future pipeline of saying, okay, we're lending on the first step. We can also lend more in the second step, and we also lend more in the third step, and it builds a nice pipeline of deals that we get to know really, really well over the years.
Right. So in that segment, in his investment, he could decide at the end of the entitlement process, do they want to exit or do they want to go in and do the horizontal development? Each chunk along the way, you've got to put more capital in, and there's got to be more investment made to be able to do it. Ultimately, culminating with you're going to go vertical and you're going to build this thing. So our plan there is work through those initial 2 phases, either the entitlement or the horizontal development with a lending debt front that we can go in with, and then ultimately say, hey, when they want to do the full equity development project, can we be part of that and work with them on that going forwards.
Right, and this is the Waller, Hutto, and Leander deals that we put together last year, and they've been a great partner. It's all going very, very well so far. It's kind of rinse and repeat now that we've built a relationship with them, and I think we'll look to continue some more with them. And the conversations with Dharma are about this is kind of a 10-year pipeline of deals, so we can kind of really get involved in every stage of it and have optionality to exit and bring in new people every time. Every stage is about a 1 to 3 year commitment. So it also gives investors flexibility that if they want to keep going on a project they know, or for whatever reason they want liquidity and they want to exit out, they can get out pretty easily.
All right, so those are the 3 types that we have done. We look back on that for the year. We did 8 different deals that matched up into this one of those 3 structures. Worked very well. They're all pay on the 10th distributions. All the quarterly updates for these will go out with our standard quarterly reports on the 20th. So very consistent on how that looks. And same thing, they get K1s and it all flows through consistently. When we think about 2025 and what it looks like going forwards, we still see plenty of opportunity to do these things as long as interest rates stay really where they are. I think everyone would love for interest rates to be super cheap, but it doesn't work that way. So as long as interest rates are staying higher, and then as long as banks are kind of being inconsistent on how they finance this stuff and how they're going to look at it programmatically, as long as those 2 variables happen, we'll be able to find a lot of debt opportunities.
Yeah, I mean, with interest rates being higher, it kind of it shocked the system, and it's really going to take probably another 2 to 3 years for banks to peel out of their really low interest rate loans that they're frankly upside down on, right? Like we have a handful of loans in the 2.6 to 2.8% range. That bank is underwater on those loans really until we pay them off. So they're kind of in a tight position until those loans are paid off, and then once those loans are paid off or they're repriced, they can't do a whole lot of extra lending. So until that happens, which I think we have at least another 12 to probably 36 months.
We're in no rush to pay off our 2.7% debt. That's not something we're like, hey, let's go figure that payoff quick.
Right.
We want to hold those, which anyone else that has fixed rate longer term debt is going to be doing the same thing.
Exactly.
That's also why we've seen, on the ownership side, a lot less volume in deal flow.
Yep.
Right? But we expect that to stay for right now, and it should provide a lot of opportunity on the debt side.
Right.
Keep doing things.
And then on our debt, when we're talking to partners, when we're looking at properties, it's those 3 different categories we really price differently. Anywhere from call it like the 8 to 12% range up into kind of the mid-teens, and it's really just based on the positioning in the capital stack. So your first lien position at a low leverage, we can price that pretty aggressively, versus being in a second lien position behind a bank and a basically non-cash flowing asset, we need to price that less aggressively.
Yeah, priced accordingly.
Yep.
So cool. All right. Well, those are really the 3 types of debt deals that we're working on right now. That's what we plan to focus on going into 2025. We see a good amount of runway available for them to happen. So if you're on our distribution list, we'll send all those out as they come up, and we're excited about doing more of them.
Absolutely.
They work really well right now.
Mm-hmm.
So we expect that timeline, as I said. I mean, it'll probably dwindle down as the market changes. Everything we look at doing, we really only expect that we'll have an 18-month, maybe 20-month window for that opportunity to work. And then they always essentially kind of like revert back to the mean and kind of go away.
Yeah, it's a lot of reason why, like when we start doing something like we've been buying a bunch of Dollar Generals lately, you'll see us do a lot really, really quickly. And you're like, where did this come from? You're doing all these Dollar Generals, or you're doing all these debt placements. Like, well, the opportunity is small and limited, so we want to hit it hard, and then we know it's going to go away. Then we can move on to the next one.
Yeah. We're really just looking to figure out what big problem is out there in the real estate space that we can go take advantage of and invest in.
Yep.
So, cool. All right. Thanks for watching, everyone. Appreciate it.